Hello, learners. My name is Omondi Clinton. I want to take you through question 22 of the pilot paper, the data analytics paper. So the question reads, you are provided with the following extracts of the statement of profit or loss and statement of financial position for Darubini Limited for the year ended 30th June 2020, 2021, and 2022. So the statements are given there for the 3 years. And then you want to basically concentrate on question A of that question. So part A says you are required to prepare the statement of cash flows for the company for the 2 years ended 30th June 2021 and 30th June 2022. So basically, when you get such a question, the first thing that should come to your mind is the format of cash flow statement. The format of cash flow statement. So once you have the format, you will know what is needed or what you're supposed to use in that question. And therefore, I will now take you to this other side of my screen to see the format which I have created here. So cash flow statement for the period ended 30th June for 2021 and 2022 will appear as indicated down here. So what we have first here, the format is the cash flow from operating activities. We will have cash flow from investing activities, and then the last part of this will be cash flow from financing activities. Okay, so having identified the three titles in our cash flow statement, let's now see how we are going to extract information to bring into our cash flow statement. So first of all, we must ensure that our balance sheet is balancing, and then we have the statement of profit or loss. So we have been given statement of profit or loss for the 3 years. We have our balance sheet down here, and as we can see, our balance sheet is balancing for all the 3 years. So let's now come to this cash flow statement and start working on the question. So cash flow from operating activities, we will always start with profit before tax. So let's have our profit before tax here. Profit before tax. So for 2021, where are we going to get our profit before tax? We simply say equal to and refer to what is given here as profit before tax for 2021. And we do that to get for 2022. Having gotten profit before tax, there are some adjustments which we need to do. These adjustments include taking away the non-cash items which were placed or which reduced our profit before tax. So one of the items which we are going to adjust or add back there is depreciation expense and also any interest that was charged. Remember, it does not mean that any interest charged here is actually paid for. It's just the interest expense for that specific year. So it does not mean it was paid for, and therefore we add them back. We add interest expense back. That interest expense is also the same as finance costs. So we have to adjust the finance cost and depreciation expense. So let's come here and do the adjustments. So the first adjustments will be depreciation expense, and then we also have finance cost, and we also have finance cost. So how will we get depreciation expense? How will we get depreciation expense for the year 2021? Let's go to our income statement and see. So if you go to our income statement here, we are able to see the depreciation expense for 2021, of which the value is 800. So remember, these items were subtracted and therefore we adjust them by bringing them back. So we will say equal to, because it is in negative, we'll say negative what we have here for 2021 as depreciation, and therefore it is adjusted or brought back. It is added back to our profit before tax. We also look at the finance costs. Finance costs also will be given the same treatment. So we come to our 2021 income statement and add back the finance cost which was charged up there. So we've now taken finance cost and depreciation back. So whatever we are going to get is the cash flow before adjustments of, or the adjustments for working capital. So we have cash flow before adjustments for working capital. So this one here, we are going to get the summation of all those values. So we say alt equal to get the summation of the total amount that we have there. So that one is the cash flow. That one is the cash flow before adjustments for working capital. Adjustment for work. Okay, so having gotten the cash flow before adjustments for working capital, we now come to the section for the bringing in the working capitals. And remember, working capital is basically current assets. So we now go to our statement of financial position and look for the current assets. So under current assets, these are the items which we have. And remember, we are going to pick inventory and receivables. That's what we are supposed to bring here. So let's now bring our inventory. Let's bring inventory and receivables. Let's bring inventory and receivables. Then we go to the section of current liabilities. So under current liabilities, remember bank overdraft is cash and cash equivalent item. And also we have cash and cash equivalents in the current assets. So the two we are not going to be used in this section. And therefore, we only pick accounts payable. So let's now pick accounts payable. So we can have them having the same name. So under inventory, remember, if there's going to be an increase in inventory, then it means we bought some goods. And by buying some goods, we are going to spend money. So that one is cash outflow. So to avoid trying to interpret that, which may confuse you in the process, you simply say, you want to look at the effect. Is there an increase? And if there is an increase, that is a cash outflow. If there's a decrease, then that is cash inflow. So what you do, you take the previous years. You take the previous year's inventory minus the current year's inventory to get that effect. So we come now to inventory here. Then we say previous year is 2020. So we say this one here minus what we have for 2021. And we are able to see that we have negative 6,750 to mean that we have bought more inventory and therefore it is cash outflow. That is what we do to also 2022. So we come to receivables and do the same. We come to receivables and do the same. And because they are just adjacent to each other, we just drag that formula and bring the values there. So you can see it is adjusting for us the receivables. So increase in receivables, we gave out goods and we did not receive cash. Decrease, the debtors paid us some amount and therefore it is cash inflow. So the effect is also visible. As you can see, receivables increased, which means that one is cash. That one is cash outflow. Okay. Okay, so having worked on accounts receivable, let's now move to accounts payable. Under accounts payable, if accounts payable decreases, then it means we paid these creditors their money, and therefore it was cash outflow. But if accounts payable increases, then we received money from creditors. We received goods on credit, and therefore that one is cash inflow. So we now come to accounts payable and do the reverse of what we did here. Instead of taking what we had in the previous year minus the current year, we now take what we have in the current year minus what is there in the previous, or what was there in the previous year. So we'll say what is there in the current year minus what was there in the previous year. So that one will give us a positive value, which means it was cash inflow. We were given another credit. We were given goods on credit. So having gotten those, we now get the cash flow after adjustments for working capital. So it's going to be the summation. It is going to be the summation of the values or the figures that we have there. So that is our cash flow. That is our cash flow. That is our cash flow after adjustments for working capital. So we have now these items which are remaining here. Remember, tax which was charged, it is the tax expense for that specific year. So is there some amount in the tax payable account? Is there some amount in the interest payable account, such that we are now able to calculate what was actually paid? Remember, this one is what is charged for that specific year, which does not necessarily mean it was paid for. So to confirm whether it was paid for, we now come here and get what was paid, that is tax paid. And then we also get interest or finance cost paid. So interest paid. So interest or tax paid, we now come to our balance sheet under current liabilities. Do we have anything like tax liability account? No. Do we have anything in the name of interest payable? No. So it means whatever was here, which was charged in our income statement, is the amount which was actually paid for that specific year. And therefore, we just come here and pick the tax paid for the year 2021 and 2022. We do the same to interest. We do the same to interest, which is now the finance cost. We do the same to interest, which is now the finance cost. Remember, they are cash outflow. That's why we indicate the negatives which are there. That's why we indicate the negatives which are there. So we now want to get net cash flow from operating activities. Net cash flow from operating activities is now the summation of all those figures. So that is what we are going to have as our net cash flow from operating activities. We are now supposed to move to cash flow from investing activities. This one here, you specifically go to non-current assets. Under non-current assets, was there purchase of PPE? Was there disposal of PPE? Those are some of the items that we are going to look for. So do we have accumulated depreciation? Not given to us. So these figures here for the non-current assets are at their net book value. At their net book value. So once we want to work out on this, do we have purchase of PPE? Do we have disposal? We first of all go to our income, statement of financial position, and go to the capital section. Do we have anything in the name of revaluation reserves? Do we have anything in the name of revaluation reserves? There is none. So it means these assets were not revalued. And if they were not revalued, the only thing that will affect their NBV is the depreciation expense for a given or that specific year. It is depreciation expense for that specific year. So let's come here and see if there was purchase of PPE. We've not seen anything mentioning gain on disposal or loss on disposal. So there was no disposal. And then these changes might have been as a result of purchases of PPE. So let's now have our purchases of non-current assets. Purchases of non-current assets. Purchases of non-current assets, how are we going to get it? Remember, for us to get that, it is also cash outflow. It is also cash outflow. So the total amount of PPE which we have for 2021, is as a result of purchase, and then we look at the effect of depreciation. And since it is cash outflow, for the purchase of non-current assets, we will say this one here minus what we have in this account, and then we add to the depreciation expense for that specific year. Then we'll be able to get the cash outflow. Let's see. What are we saying? We are saying what we have in this account is as a result of purchase of a non-current asset. So this one here plus depreciation expense. So we subtract what was there at the beginning plus the depreciation expense for that specific year. We are going to be able to get what was actually purchased. So when we take the current balance minus opening balance plus depreciation expense, we are able to get what was actually purchased. And therefore, remember, it is a negative. It is a negative value. So for you not to insert the negative there, what you need to do, just start with this one here. Just start with this first part of the formula. Just start with that first part of the formula for you to get a negative value directly. We do the same, just autofill, and you'll be able to get your balance for the purchases of PPE. So since it is the only item under investing activities, it is also going to be our net cash flow from investing activities. It is going to be our net cash flow from investing activities. Then cash flow from financing activities. Cash flow from financing activities. Cash flow from financing activities. We now go to section of non-current assets and capital. So non-current liabilities. We go to the section of non-current liabilities or long-term liabilities. So if I come to the section of long-term liabilities, I'm able to see only one item, that is long-term borrowings. So these long-term borrowings, as I can see, the amount is increasing, and therefore it means we received more loan, which reflects cash inflow. So for us to see the amount which we actually received, we now bring the receipts from long-term loans, and we'll say what we have for 2021 21 minus what was there for 2020, we will be able to get what was actually received in that specific year. We'll be able to get what was actually received in that specific year. So do we have any other thing under capital? As you can see, under capital, we should look at capital. We should look at share premium if it is there. So retained earnings is already taken care of up there. We only look for the paid up capital. This paid up capital is constant all through. So there was nothing which was affecting it. And therefore, it is only one item which is also under financing activities. Do we have dividends paid? No, we have not been told anything about dividends. We have not been told anything about dividends. But still, if it was there, we can identify that by looking at this. The retained earnings for 2020 is loss of 7080. Is loss of 7080. So loss of 7080. So we'll say is equal to loss of 7080 plus profit for the year, plus profit for the year of 2021. What are we getting? We are getting 3052, which is the same as what we have here, 3052. That difference. So that small difference is just as a matter of rounding off, but we are able to see if this one here could have been less than what we have here, then we could have said there was some dividends which were paid. But since it is the same, we are taking it now as that there was no dividends paid and retained earnings remained the way it was. So no dividends which was paid, and therefore this is the only item falling under financing activities. So our net cash flow from financing activities will only be that single figure. So let us now get the net cash or net changes in cash and cash equivalents. So we are going to say equal to summation of net cash flow from operating activities, net cash flow from investing activities, and net cash flow from financing activities. So that's what we have there as net changes in cash and cash equivalents. That's what we have as the net changes in cash and cash equivalents. So cash and cash equivalents brought down. Cash and cash equivalents brought down is what we have in the previous year. So do we have that in the previous year? Cash and cash equivalents in the previous year? Yes, the opening. So we'll say equal to, do we have under cash and cash equivalents for 2020? It is 0, so we pick that. And remember, we have under current liabilities, we have bank overdraft, which is also an item of cash and cash equivalent. So we say minus this one here, bank overdraft. So when we bring that, we are getting a negative cash and cash equivalents brought down. A negative cash and cash equivalents brought down. That's what we have there. Okay, cash and cash equivalents carried down is the net changes in cash and cash equivalents. Then we adjust by now adding these two items here. So when we add those two, what do we get? We are getting 9323. That is cash and cash equivalents carried down negative. About 2022, we are having 3823. So these ones here, these balances here must just be equal to cash and cash equivalents as per the statement. So let's see if these figures are going to add up would be equal to what we have in our cash and cash equivalent in the statement of financial position. So we'll say equal to cash and cash equivalents for 2021. We subtract any bank overdraft, which is this. So when we enter, that's what we get. And let's also come to this part and see. So if we look at this one here, the figures that we have for cash and cash equivalents as per the statement are actually these ones here. And that's what we have. That's what we have. This one here is as a result of rounding off. But then when we look at these two, we are able to get that they are adding up. They are adding up. So that's how you are supposed to solve that question for the cash flow statements for these 2 years. That is 2021, 2022. So we have now worked out the pilot paper question requiring you to do the cash flow statement. So thanks for your time. Thanks for your time, and we'll work on other questions as time goes, and we will also chart our way forward to see areas that you don't understand and do some revision pertaining to those areas. Thanks for your time and have a blessed time.